Hello, I'm CA Srinivaso. And if in this particular financial year 24-25, you have a portfolio which is in red, and if you want to reduce your tax liability, then this video is meant for you. Let's understand with my presentation what is the meaning of tax loss harvesting. See, what tax loss harvesting actually means is picking out the stocks in your portfolio which are loss making and selling them and adding them back to your portfolio on the next or immediately preceding day so that the same loss can be set off against the profits of the rest of the stocks and your tax liability reduces. So what you can do is you can choose the stocks in your portfolio which are loss making, but you want to keep those stocks. You can sell off those stocks, and on the next immediate day, you can again buy them at the same or marginally higher or lower rate. But before that, let us understand how to do this, and there are certain basic rules before doing this which you need to understand. First of all, what is long-term capital loss? Long-term capital loss refers to the losses on stocks which you have held for more than a year. Now, if you have a long-term capital loss, it can be set off only against the long-term capital gains. It cannot be set off against short-term capital gains. So you have to be very clear which stocks you have been holding for how much time. And if you book the loss on that stock, whether it is going to be a LTCL or STCL, that is long-term or short-term, that you have to determine first. Short-term capital loss is the loss for stocks held for less than 12 months, less than a year. Now, it can be set off against short-term capital gain or long-term capital gain, both. Now, if you book losses, but you do not have any particular short-term or long-term gain in the same financial year, then those losses can be carried forward for the next 8 assessment years. Okay. Tax rates which are there for short-term capital gain up to 22nd July, that is before the latest budget, for that particular financial year, it was 15%, and post 22nd July, it is 20% for short term. For long term, the basic exemption limit is 1.25 lakhs annually. So up to 1.25 lakhs of long-term capital gain, you do not have to pay any tax. But above 1.25 lakhs, the tax has to be 10% up to 22nd July and 12.5% post 22nd July. Now, what you have to do is when you are selling those loss-making shares in your portfolio, you can sell at the end of the day, end of the trading session, and then buy back on the opening session of the next day. Okay, you can refrain from high volatility periods so that the gaps are not very high. And also you have to remember that for the purpose of the realized loss calculation, always the FIFO method is used. That is first in, first out. So if you totally have 100 shares, you book losses of say 30 shares, then the stocks bought first 30 bought shares will be considered for the purpose of calculating that realized loss. Okay. Realized losses can be very different from what the loss is displayed in the holdings. So you have to carefully read the holding statement or the realization statement from your broker. You get all those detailed statements from your broker, but you have to read them very carefully. Okay, so that's it from my side. This is a very important tip for anybody who is having shares in the portfolio, but these are loss making. Because of this method, you can reduce your tax liability for this particular year and save on taxes. Thank you.